Question, what about the provisions that prevent an audit of the Fed? The Fed is exempted from audits not only in the area of monetary policy, but also foreign agreements. And all of the efforts by the Fed to defend their exclusion from audit have focused on, well, that could affect monetary policy, which begs the question, why is the Fed demanding an exemption or a continuation of exemption of its foreign agreements from the audit process? If supervision informs monetary policy, then we have to ask why the other bank supervisors are unwilling to share information with the Fed, and why economic statistics are not being shared not only with the Fed, but with the American people. And finally, as the Supreme Court decides that corporations can control who holds governmental posts by spending unlimited amounts of money on campaigns, at least there, in order to get a particular person selected for governmental authority, they have to convince humans to vote for them. The one exception to that is the Fed regional boards, where corporations get to select who sits on these boards and who exercises governmental power without them being responsible to the voters at all. In a democracy, every agency of governmental power should be responsible to the electorate. I yield back.
Thank the gentleman for his opening statement.
Done to our social and political institutions, done to the social contract by the Wall Street bailouts and the prospect of future bailouts, which exists as long as we allow to exist institutions that we brand as too big to fail. Chairman Volcker, with 3 federal prudential supervisors plus various states, how can we in the future get consistent, comprehensive, and effective regulation and supervision of all banks and similar institutions? Shouldn't there be a single body for setting out one set of rules that all the supervisors would apply consistently?
Well, conceptually, there could be one supervisor. I think that's the way to go. Many countries have it that way. We have a particularly big and complex country and financial markets with its own traditions, and that has led to a multiplicity of regulatory agencies, and I think it's fair to say a certain amount of confusion. And we've got to do better in coordinating what they do. And we've been left with extremely weak supervision outside the banking system as a matter of historic development. But let me say on the other side, as I said in my statement, and this is basically a political decision, there are some advantages in having more than one regulator. Many instances, I think, countries find a single regulator gets pretty rigid in its bureaucracy, and there are legitimate complaints by the financial institution that there's too much room for innovation and flexibility and freedom. On the other hand, I don't want regulatory agencies competing with each other in liberalism. How you can,
I can agree with you on
those two things. I think what this comes down to, I'm obviously...
I need to interrupt you because I've got 2 other questions to squeeze in. Chairman Bernanke, you have outlined the advantages of mixing monetary policy and bank supervision, and I want to address one of the perceived disadvantages. I'll ask you not to just offset it by saying, well, here are all the advantages, but rather address the disadvantage. Bureaucracies hate bad headlines. They'll often do desperate things behind the scenes to avoid that big headline from breaking. Prudential regulators are going to get bad headlines if a big institution fails, particularly under some circumstances. And they can prevent that failure if they can just put it off for 6 months. Their reputations and careers can be saved. Monetary policy, just cutting the interest rate by a quarter point, can save a troubled institution. So how can we be sure that monetary policy is not influenced by the natural human desire of bank supervisors to save one or two institutions for at least long enough for them to move over to another department, how do we make sure that monetary policy doesn't meet the career needs of bank supervisors?
I don't think that's a very realistic scenario. If a bank was really that sick, I don't think a quarter-point interest rate change would help it very much, and the consequences...
Well, every dying patient is on the borderline at some point. And yes, there can be circumstances where it's touch and go.
Well, again, I don't think that's an efficient way or effective way to even to achieve that objective. And I suspect, and the central bank chairman would nevertheless still be presumably around and concerned about his or her reputation when the economy has excessive inflation or whatever problem might arise from bad interest rate policy. I don't think there's much evidence for that particular issue.
Oh, I'm going to squeeze in one more question. You may have to respond for the record. Why should our statutes exempt the Fed from audits of, and I'll quote the statute, transactions for or with a foreign central bank, government of a foreign country, or a nonprofit international financial organization? And are you willing to provide for the record a description of all such transactions from the 1990s, where they're old and cold, so we can get an idea of what the bank was doing internationally?
We've told you. I mean, we've been doing
Mr.
swaps.
Chairman, you've been invited to submit your answer to that for the record.
Oh, okay. Thank you.